A crisis is brewing the trucking industry that could spike inflation, wipe out hundreds of thousands of jobs, and drag the entire stock market down with it. Now, why is that? Because where transports go, the economy always follows. Now, buckle up. This isn't Wall Street fluff. It's the freight train that's about to derail the economy. Plus, tonight's show is brought to you by Upexi. You can find it on the NASDAQ and symbol UPXI, and they're building the next generation in crypto treasury model. Now, their stock is about to break out. It's been setting a series of higher lows, and it just closed over its 6-month volume profile. This is one trade you don't want to miss. Stay tuned to the end of the show or check out the pinned comment or description for more information. Now, Derek Leathers, he's the chairman and CEO of Werner Enterprises. He's been warning a tight capacity and higher operating costs in the trucking industry. And he said, we're at a tipping point. Capacity is leaving the market little by little. The industry needs significant rate increases. That's inflation he's talking about. And this isn't just about survival. It's about making sure trucking can continue to deliver America's goods safely and reliably in the years ahead. What you're seeing here is a post-pandemic problem. We have too much capacity and demand is plunging, and now this is affecting the transportation sector. And it's not just trucking, it's shipping as well. Because as the economy slows, you start to see signs of the payback period beginning. And where we're seeing this right now is the case of excess capacity. Now, this isn't an isolated incident. It's not just the trucking industry, and it's certainly not something to be ignored. Now, it's a canary in the coal mine for the economy because, again, when transport slump, the broad economy follows. Now, we've seen this in the manufacturing PMIs. They've been contracting for 9 straight months. And how about the services sector? We just talked about it. It's been stagnating right around 50 for months at a time. And what this is indicating right now is that inventory levels are too high, demand is plunging, and we're seeing it backfeed all across the economy. In fact, imports right now are dropping 6.8% year over year, and it's going to get worse. And all this is going to do is have a major impact on the transportation and logistics sector. In fact, this is a tipping point I've been warning about. The start of a freight recession drags the whole economy down. Let's take a look. Because obviously rates have been depressed, although stable. They're stably horrible for the most part over the last several years, well below people's operating costs in many cases. In fact, at a minimum, it's not a reinvestable rate. And when you start to look at spot rates, now they're down about 6.9% year over year. And what this is telling us is we have too many trucks and not enough freight. Now, when you look at the correlations, not just of the domestic economy, but the entire global economy, what do we find out? China and the US, we've got too many new homes, not enough buyers. How about in Germany? They've got too much production of automobiles, and again, not enough buyers. China's got too much capacity in its manufacturing sector, not enough new orders to sustain it. Here in the US, we've got too much inventory across retail, wholesale, and the manufacturing level, not enough consumption. And what this means globally is too many workers, not enough business to drive the labor market. And the problem for the transportation industry right now is drivers are going to be forced to leave the industry because they're not making money. They're losing money in a lot of cases. And this is exactly what happens in every part of the economy. So it's not just isolated. This is what happens when demand drops. So you enter an adjustment or payback period when you pull all this demand forward, which we did from the pandemic and front running the trade war. What you find out is supply and demand needs to rebalance. The problem is demand's dropped off and we've got a whole lot of supply in the economy. Now, yesterday we talked about a slowdown in the services sector that could impact millions of jobs. Let's think about the trucking industry. 4% of GDP. That's 8 million jobs in logistics alone. 3.6 billion of them, those are the drivers, those are the truckers. So you think about a small pullback here and what it means for the economy. We're talking hundreds of thousands of jobs potentially lost. And when we go back and look at the continued claims data, we see it hovering just under that 2 million mark that I said if it breaks out, we're going to see the economy unwind. And right now, the transportation sector is telling us there could be a major unwind as we're sitting right at the tipping point. Now, we've talked about spillover effects. Check this out. Now let's take a quick look at the stock for our sponsor of today's show, because I want you to see just why I'm so bullish on it. It's not just because we have 5 buy signals across 5 different trade strategies, but look what happened after this big pullback. It set a series of higher lows. It just crossed over and closed above its 6-month volume profile and setting up a big move potentially to hit $10 a share. Now, for more information, stay tuned to the end of the show or check out the pinned comment or description. With Class 8 truck orders at historic lows and OEM scaling back production, he predicted it could take years to rebuild the manufacturing capacity, leading to higher truck prices, quote, at a time we can least afford them to be more expensive. But isn't that true about everything in the economy right now? We can't afford for anything to go up in price because we already know consumers cannot afford higher prices. Businesses don't want higher prices because they can't move their inventory. And so what this means, less demand for freight at the manufacturing level is going to be a problem, because as you see a pullback in manufacturing, well, that means a lot fewer goods are going to be shipped. Now, we talked about yesterday how the services sector derives about 10 to 15% of its revenue from manufacturing. So what we're seeing here right now is a pullback that is not turning around. And the risk we're facing, if there's any further declines in manufacturing, it would risk further declines in hours worked and jobs. Let's take a look at this chart of durable goods new orders against average weekly hours of production and non-supervisory employees. And the reason is so important because what you're about to see in the transportation sector. And what we can see in blue, as new orders decline, what happens? Weekly hours go right along with it. And you can see a very strong relationship between the two. Now, the risk we're facing right now is we don't do orders are about to head a lot lower. And with that, these hours are about to drop as well. And here's the evidence, because we now have reported the preliminary September Class 8 truck net orders at 20,500 units. Now that rose 60%. This was month over month in August, but are now down 41% annually. That is a staggering number, my friends, and what it represents is the 9th consecutive months of annual declines. Now think back to the manufacturing PMI, 9 straight months of declines. You can see what's going on right now in real time. And this is what's concerning, is a trend as order boards are open. Easy to get orders in for 2026. The problem is people don't want them. It added that orders were far below the 10-year September average of just under 30,000 units, underscoring fleet hesitancy amid trade tensions, tariff uncertainty, and broader economic headwinds weighing on freight demand. So again, you think about the ISM manufacturing survey. What did it say last week? There was a decline in new orders, a decline in backlogs, and a decline in new export orders. So what we're seeing here is there's no sign from the transportation sector, and they're a leading indicator of where the economy goes, that we would see any sort of improvement. In fact, what we're hearing from the transportation sector is now we're at a tipping point and things are about to get worse. But I want you to think it's not just those in transportation and logistics that are at risk, it's the manufacturing levels too, because as production goes down, the need for employees goes right along with it. But let's turn to imports, because I've been warning that a slowdown in imports was going to lead to mass layoffs. Remember, we've been talking about the slowdowns at the Port of Los Angeles and Long Beach and how it impacted the logistics sector in a major way. We heard from trucking companies say, look, if demand doesn't pick up, we could be out of business within months, and this is a real problem. Let's look at some projections. We see October forecasted to be down 13.2%, November down 19.7%, December to be down 20.1%, and January 2026 looking to be down 19.1%. These are all year-over-year numbers. So you think about the impact this is going to have on the labor market and why we're at an inflection point, why the transportation sector is saying we're at a very clear tipping point. Now let's take a look at this next chart of imports of goods and services against average weekly hours of production and non-supervisory employees. And I want you to see very clearly when imports in blue go down, it has an immediate impact on weekly hours. And again, you can see that throughout every cycle. So as we look at the projections, what we can expect is that blue line is going to cross below that horizontal black line and go negative. And with that, it means hours worked are going to drop. So you think against the backdrop of still rising inflation, a slowing economy, a weakening labor market, what this means for a lot of American households right now is their paychecks are going to continue to shrink. It means their spending is going to shrink. And all of a sudden, all those surveys about holiday spending, well, it starts to make sense. But there's also the risk in the stock market because where transports go, the broad market follows. And right now, everyone's looking at the S&P 500 and NASDAQ 100 and saying, look, there's nothing wrong with the economy. But let's take a look at this chart of transports. We're going to look at the ETFs here. This is IYR against SPY. And what you can see is the S&P 500 in purple and IYR, that is the symbol you can see trading in the red and green. And you can see the great relationship because when transports sell off, well, the broad equity market goes with it. The problem we're facing right now, my friends, is they're not following up to the upside quite as fast. And that, again, is creating a gap here. It's a red flag because when we go back to the financial crisis, we can see leading into it, the S&P was rising, transport started to roll over, and next thing we know, the entire thing started to fall apart. And that is the real risk here, is we have to be watching what transports are telling us about the economy because, again, they're a leading indicator. And this is why the regional Fed surveys that we talk about on the show, the ISM, the S&P Global PMIs, they're so crucial. Because if there's going to be a turnaround in the economy, there's got to be a turnaround in new orders. But the risk is, if there's continued contraction, it's a sign of impending doom. But you also want to keep an eye on the major transportation ETFs and indices. You want to look for them to catch up to the broad market. And if it does, that's validation in the economy and the markets that things are turning around. If it doesn't, it's a warning sign, my friends. You may want to take profits and look to put some defensives into your portfolio. Because the real reason the transportation sector is so important is because based on the data we're seeing right now, we're at a tipping point, an inflection point that indicates the economy is about to take another move down, and with it, several 100,000 jobs. And that's the best case scenario if we don't enter a recession. If we do, could easily be millions. Now, do you or someone you know work in the transportation and logistics industry? Drop a comment. I want to hear from you what's really going on right now. And be sure to like and subscribe for more. Now, something I am bullish on has been a big winner for my viewers. That is their stock for our sponsor of today's show, Upexi. Again, you can find them on the NASDAQ and symbol UPXI. Everything you need to know in the pinned comment and description below. Because Upexi is a forward-thinking public company building a treasury focused on Solana, a high-performance blockchain designed for mass adoption. And Solana, launched back in 2020, offers ultra-fast, low-cost transactions with its proven history technology, making it a leader in active addresses, daily transactions, and decentralized exchange volumes. Its robust ecosystem supports finance, gaming, AI, and more. And Upexi's strategy provides crypto exposure through familiar equity structure, improving on MicroStrategy's playbook by aggressively acquiring Solana to capitalize on its growth and enhance shareholder value. Upexi's fiscal year ended on June 30th, and they posted $15.8 million in revenue and a Solana treasury of now over 735,000 SOL, valued at $114 million, which has since surged 174% to over 2 million SOL, worth $433 million as of late September. With staking yields generating about 100,000 a day, you can see they're poised for massive growth. Additionally, Upexi welcomed SOL BigBrain, a key cultural leader in the Solana ecosystem, to its advisory committee, strengthening ties to Solana's community and innovation. And Upexi's capital market flywheel leverages large-scale, accretive capital raises to acquire and hold Solana, aiming to maximize value while employing risk-prudent practices like native staking and validator diversity. With seasoned executives and a focus on operational excellence, Upexi bridges crypto and traditional finance, offering a compelling opportunity to participate in Solana's growth. Now let's take a look at their stock chart here. You can see poised for massive growth. Not to mention we have 5 buy signals across: trend pullback, turtle trading, their meta strategy, even the enhanced version, and of course the Bravo 9. But let's take a look. After a massive pullback, what happened? The stock has been setting a series of higher lows, recently just closed over a 6-month volume profile, setting up a move to potentially hit $10 a share. Again, this is a big move you don't want to miss out on. As always with any company we feature on the show, you're under no obligation to purchase their stock. Be sure to research before placing any trades and use your risk control levels when you do. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.